Welcome to the Data Room, where we demystify go-to-market data for financially strategic execs. We deliver real-world guidance for finance and go-to-market teams, helping them collaborate to transform their data into a strategic asset. I'm Scott Stauffer, CEO and founder at Scale Matters. I've been a CEO for over 30 years at various tech and SaaS companies, and I've seen firsthand the power of using data and data modeling to understand what drives value creation in a business. I'm Scott Stauffer, co-founder and CEO of Scale Matters. Welcome to another session in our ongoing webinar series of Bridging the Gap between finance and go-to-market. I'm super delighted to have with me today Ben Murray, also known as the SaaS CFO. He's joining me to talk about something that's evolving very fast: how we forecast, how we measure, how we define performance in recurring revenue businesses. We're going to dig into kind of the shifting landscape of SaaS metrics and what finance leaders have to do to keep up. Most of you know Ben or know of him. He's widely known and appreciated in the world of SaaS finance and metrics for all of the wonderful thought leadership content that he makes available. And today is just part of that. So Ben, nice to have you here. Appreciate you being with us.
Yeah, great to be here, Scott. Yeah, looking forward to it. And thanks. Yeah, thanks everyone for joining. Yeah, some familiar names out there.
So we're going to focus mostly on the importance of forecasting and kind of how it's traditionally been done by finance, and how, if you add more depth potentially from the go-to-market perspective, your forecast can become a powerful growth model. We'll also spend time on some SaaS metrics in general, and kind of how to move them from merely something to report on to board and investors and turn them really into kind of legitimate operating tool, so that you all who are operating leaders can actually leverage these metrics to improve outcomes. So I'm going to turn it over to Ben. He's got some prepared slides. We'll probably spend 10 to 15 minutes with Ben talking through his stuff. Then we'll do a little back and forth between Ben and I, and then I'll offer some closing perspectives and Q&A after that. So Ben, take it away, and thanks
Yeah.
again for being with.
Yeah, thanks, Scott. Yeah, welcome everyone. Good morning from Scottsdale. Great to be here. And yeah, if there are any questions, comments, throw those in the chat. I'd love to take questions at the end. But if we haven't met, love doing these educational webinars. I got started in the airline industry, then got into software in the early 2000s, and then worked my way up through FP&A to SaaS CFO, and now doing fractional CFO work, coaching, have an academy, teach SaaS metrics and finance. So really living and breathing B2B SaaS finance and metrics today. So quick agenda, and we could talk hours on this, on forecasting, on metrics, on segmentation, but some teaser slides just to kind of peek into in my CFO world of how I forecast, how I think about metrics, and of course that important relationship between GTM leaders, CFOs, and all the data that we need in those two groups. So talk a little about forecasting, about my metrics framework, metric segmentation, which is a big deal once you scale. And I'll go through ARR real quick, but we know this is a hot topic right now. The definition of ARR is changing. Do we have subscription? Do we have usage? Do we have outcome-based? Some other type of pricing? And that really affects how we calculate metrics and measure ARR. And then talk a little bit about, the topic du jour or SaaS metrics breaking. So first, forecasting. So pulling the pieces together, and why is this so important? And really, my forecast process is the engine for metrics, for clarity, and for the reporting that we need in tech businesses. And, for me, this is kind of a sneak peek behind the scenes. It all starts with our invoice data, our customer data, our revenue data. So important, because you think about all these customers that we're invoicing and that we're landing. Well, we need all that metadata associated with this. And then, Scott, this comes up all the time in conversations when I help founding teams is, all right, we've got this data, but now we need to enrich it. Where are these leads coming from? Do we have it segmented by ICP? Something else that we can take a CAC number and then segment it further. And that's the real magic of thinking about that data foundation between finance and in our CRM data, in our PLG data, wherever it resides. But all with revenue forecast, it always starts with the data foundation and actual data. So customer data, invoice data.
Hey Ben, quick question before you go on. When you say invoice data, I understand what you mean, but that brings up the interesting question of cash accounting versus accrual accounting.
Mhm.
Um, do you have a hard position on whether you should use one or the other?
Yeah, generally what I advise is cash accounting is fine, cash basis up to around 2 to 3 million of revenue or ARR. But then once you've hit 2 to 3 million, that's where usually things are getting interesting in tech businesses and we have that path forward. We're scaling, we're investing, maybe we raise some money. And that's where I say we've got to go to more accrual or gap because we have to understand the true economics of our business. Because cash basis P&L, we won't be able to truly understand the performance anymore.
Okay. Yeah, I'm aligned with that.
Yep. So there's a transition there and then, getting a little bit more serious about our accounting. But again, invoice data key to this process and I'll tell you why. But once we have that invoice data, which is sometimes harder to grab than we think, then we create our MR schedules. And I tell everyone, treat your MR schedule like gold. Everybody wants this. You go through due diligence, you go through fundraising. They want your MR schedule because they want to calculate key metrics off of this. But also, this helps our forecasting process and then also segment our data. So we have invoice data. We create an MR schedule. Again, I have Excel templates if you want those that help you with this, or tools and software do this for us. So invoice data, then to the MR schedule, and then to the MR waterfall. Now, this is the waterfall. We have beginning balance, new expansion, contraction, churn. Some people call these roll forwards, snowballs, but this is so important. This is so important in the forecasting process. And also with our metrics process, because once we have this MRR waterfall, we can calculate, those all important metrics for recurring revenue businesses, retention. So we can calculate customer retention, gross revenue retention, and net revenue retention. And this also sets us up for success in forecasting, and creating accurate recurring revenue forecasts, because then we have assumptions by each of these MR layers, which is so important. We don't want to just say, hey, we're going to, gain another 50,000 of MR next month. Well, is that coming from new expansion? What assumption do we have for contraction, churn to get to that net number that we're forecasting in our P&L forecast? So the outputs of this, invoice data, schedule, waterfalls, then we know customer counts, we know customer retention, and like I said, gross revenue and net revenue retention. We can calculate that historically, and then I'll also use that as inputs into the forecast so that we can have assumptions by each MR layer, each product line, each segmentation of revenue once we get big enough. So important part of the process.
Yeah, so where you're calculating the retentions there, and you're doing it off of the monthly, MRR,
Mhm.
which is typically pretty accurate even if it's not tied to cohorts.
Mhm.
When you start talking about, annual retention figures,
Mhm.
do you believe that that should be off of cohorted customer basis or not necessarily?
Great question. So here's my stance on this. So we have aggregate revenue retention, which is what I'm doing here. Then we have cohort retention. Now you'll see social media posts that say, "Hey, cohort retention is the only way to calculate retention," which I disagree with, because if you're landing one enterprise customer a month, cohorts don't do any good. We don't have enough volume of data flowing through these calculations to make that a valid measure. Now, if you're acquiring 10 customers a month, 15, 20, then yes, then there's enough data where we should run both aggregate revenue retention and then also cohort retention.
Okay, that's good guidance. Thank
Yeah. Yeah. So if you're SMB, PLG, yep, we're doing cohorts. But if you have a big price point product, maybe less likely that we're looking at cohort retention. So key considerations in the forecast. Well, revenue type. When we land a customer, and this is a big deal when I work with GTM teams and founders, like when we land a customer, what are we landing? Is it subscription revenue? Is it usage? Is it undetermined? Because then that forms how I'll calculate CAC payback, cost of ARR. If I don't know that, then all my GTM efficiency metrics, I'm not sure what to do there. And then revenue segmentation. Are we doing this by product line? ICP. I've worked with companies where we're segmenting revenue and acquisition by PLG sources, SLG sources, because again, we can't combine that data when we're looking at the forecast and the metrics. And then again, I mentioned assumptions by MR layer. And then also pricing plans, maybe we have good, better, best, different things that we want to track our revenue forecast and metrics that way as well. So I mentioned metadata data earlier, so important that we're aligned on all that metadata that's flowing between sales, marketing, and finance. And then also, Scott, we were talking, maybe later, we were talking about this, the 80/20 rule of forecasting is, I need assumptions, like, especially with new business, we need assumptions for that. And where is that coming from? So an 80/20 rule that I follow with forecast, that we have enough detail in there to make the forecast accurate, but also the forecast model doesn't become too tedious and burdensome to update every month.
Yeah. And we'll dig into that a little bit after your pitch here.
Yeah, and this is my forecast model is floating. Thousands of my forecast models are floating out there, helping CFOs and founders. But this is one screenshot from my forecast model, my SaaS forecast model, and you can see all the detail here. And I built that data foundation previously. That then I can load all this data into my forecast model, and I know exactly how expansion is running, contraction, churn, how many new customers am I acquiring, what's the average ACV of all those customers, and I have that data at my fingertips to create an accurate forecast. And that's so key. We don't want to just say, hey, our revenue's growing 20%. Yeah, that's great, but we need all that detail. And this is just a sneak peek for all my CFO, FP&A friends out there, of the how I build up these forecasts. And you can see assumptions by every layer in here. And then impact on metrics. So again, I mentioned my forecast process is my engine to calculate historical metrics, forecasted metrics. And this is my SaaS metrics framework. And again, I'm happy to share these slides after if you guys would like these, but this is what I implement for tech businesses. And, there are a lot of boxes up here, but guys, if you're above 5 million in ARR, usually I can calculate a metric in each of these boxes. If you're above 10 million ARR, you should have a metric calculated in each of these boxes. And also then above 10 million, thinking about metric segmentation, not just one CAC payback period, but should we segment CAC? I was working with one very large SaaS company near 100 million ARR, and just the way they had set up the accounting and the GTM and the finance data, they only had one CAC, but they were 100 million ARR, right? Because the data foundation wasn't there. So we've got to think about that and that progression in our financial maturity.
Related to segmentation of metrics, one of the listeners has asked a question. If you have both MRR and ARR revenue streams, do you find yourself blending them into one blended metric or running them separately? And I guess we may need a little clarification on why they would be different, other than one being 12 times the other.
Yeah, I need a little bit that's what I was thinking.
Yearly
It's
stuff.
it's monthly invoicing versus annual contracts. So, yeah, yeah, so great question. So that I I'm gonna have a different revenue tab for each of those. So if we have a monthly invoicing plan where it's month to month, definitely the firmographics around that customer profile would be different than our annual invoicing customers. So I may have 2 tabs, one for the monthly and one for annual, and different assumptions for each. So definitely I usually would not want to blend those together. And then the question usage based, yep, that's going to be a whole separate assumption of retention calculation, customer counts, activity, unique transactions. So that'll be a separate revenue tab as well for the usage side.
Yeah, makes
So
sense. Thanks for your question, Reason.
yeah, great questions. So yeah, keep them coming. So you talk about this metric segmentation. This is the big challenge, right? This is, like I said, the data can get so messy if we don't put that foundation in place, and CFOs and GTM teams working together here, because it really relies. Maybe we have decent lead attribution, or we know, okay, this customer is acquired and this is the ICP or this is the metadata associated with it on the revenue side. Usually a lot easier to segment revenue. But on the expense side, this is where things get hard, because I hear a lot of things, we want CAC 5 different ways. We want CAC by this channel, that channel, that channel. And it's really hard because it relies on all the expense data on our P&L in our general ledger. And if we're going to get more sophisticated, we have to start thinking about expense attribution. So marketing, are we coding expenses by, those Facebook ads, by conferences, events? If we want CAC by those channels, we've got to get very sophisticated on the expense side. And that's where marketing and sales teams, especially marketing teams, really have to work with your finance team to understand how should we code these expenses, and also CFOs educating marketing of like, hey, here's how the structure works. Here are how we need expenses if we want to segment CAC in ways that are meaningful to our business where we can actually make decisions off of those.
Yeah, and let's emphasize that a little bit more. So that's an area that Scale Matters spends a lot of time with our customers, Ben, is we call them cost attribution models, right? But if you think about leadership teams wanting data to help inform actions that they might take in order to improve outcomes, well, let's talk about channels. Which of your channels are delivering the best ROI? Which are delivering the worst ROI, right? So you can double down on the good ones, take away from the productive ones, or maybe same thing with ICP. Simply looking at cost per lead or cost at the very top of a funnel doesn't really help these companies. In fact, it may steer them in the wrong direction. So you really to get in the best position to do value creation activities, you really do have to look at ROI, which means you've got to deal with the cost stuff. And so it does require, as you said, potentially changing your chart of accounts a little bit better to keep track of the stuff that you can, particularly on program spend. But we've found that you also have to attribute talent spend.
Mhm.
And there's not a real good kind of digital or scientific way to do that. But we found it pretty useful just to have kind of quarterly or twice a year sit downs with the people and talk about how they're spending their time as a way to do attribution models there.
Yeah, so important. That's one of the first things I do with new clients is what I call a P&L deep dive. We go through every single revenue account, expense account, what's hitting there. Do we need the additional detail? Do we have a cost structure in place? Do we have all labor contractors hitting the right cost centers? So not just GTM, but yeah, we don't want other expenses mixing with GTM or GTM expenses in other cost centers where we're losing visibility. So yeah, Scott, extremely important. So challenges, right? Lead attribution, always an interesting topic of making sure we know where these, the channels, a lot of, companies, of course, as we talk, we start out with one product, one channel, pretty straightforward, but maybe then we want a partner channel. Maybe we're going to create a self-service sign up, lower, ACV product. So we've got to think about where we're gaining our customers. And then again, those expenses that are directly tied to those channels and assigning those as close as possible, and then there could be some allocation process in there as well. But again, usually it's where it's the expense side that gets really difficult, and that's where the 2 teams have to work together.
Yeah, we've seen a lot of companies struggle with that, particularly if they're trying to do channel-based attribution, and marketing folks want to do multi-touch attribution and really identify all the influence. There is no great way to do that, but I would share that one of the things that we've found over the years at Scale Matters is for most companies, if you have a sales force,
Mhm,
the bulk of your cost on GTM is incurred once the sales team gets involved.
mhm,
And so we tend to like attributing to whatever the most recent touch was that kicked off the involvement of salespeople. So I won't call it a best practice, but it's a logical practice and a good way to start to understand ROI on a channel basis and that sort of thing.
yeah, yeah, definitely. So that's where I think personally where CFOs spend a lot of their time is in the go-to-market function. So real quick, I won't go through this, in detail here, but ARR, the definition of ARR is changing, and we have to make sure we're staying on top of that, especially the CFOs out there. Of just, the big thing, is, I analyze all these public company filings, because pricing models are changing. And that impacts how we calculate metrics, what we're tracking in our CRM data. And again, won't spend too much time on this, and I'll cover this on another future webinar. But just making sure we know when we say what's ARR, is it pure subscription? Is it subscription plus variable? So we have subscription plus we're annualizing maybe the last 90 days of usage to get to an ARR number that we're reporting to our board, influencing our metrics. So this is really important. If you have a complex pricing model or different pricing models, we have this, same definition internally on this. And then some companies are pure usage based, then how we're figuring out, how does that translate into metrics? But again, our SaaS metrics no broken, no, they're evolving. You see everything as I was researching the definition of ARR, all these people posting like, our SaaS metrics broken. Are they breaking? Are they dead? Is ARR dead? And really it's evolving. And with this, are we trying to fit, a square peg into a round hole with some of this stuff where, the SaaS metrics framework is one thing, but maybe we're an AI native company, usage based, and, that could be a different model, different metrics that we look at versus saying the SaaS model or the metrics are broken. It's a variation on the model. So I don't think metrics are broken right now. They're just evolving. And one thing I teach in my course in my academy is say CAC payback period. If we have subscription plus variable revenue or usage, we've got to adjust that formula. At the top here, this is the traditional formula for CAC payback period. But that's the big thing. What's our prize? When we land a customer or a user, what are we landing with that customer? Again, is it subscription plus usage? Do we have to estimate that usage? Is there a minimum commitment on that usage? And all those things we have to figure out in the contracting process so that's clean, so we can invoice correctly and then calculate metrics correctly. So this is where we're adapting. If we're in the subscription plus variable model, some of these metrics are changing, and we've got to make sure we do that and we understand the inputs into these. And again, this is a big one that always comes up with students in my academy is GTM impact on metrics calcs, post-sale expansion. Who gets credit for this? You know, are we in a PLG motion, where maybe sales isn't involved yet? Or does sales jump in after we acquired a PLG customer? And that has a huge impact on metrics, especially if we're PLG and we land a customer and if we expect them to go from 10 to say 50 in 6 months. Well, should I put the 10 or the 50 in my CAC payback calculation? And that's really important. And that's really going to sway these metrics. So we have to understand that's why CFOs get involved in GTM, or at least understanding it is what do those funnels look like? What do lead funnels look like? What do pipeline funnels look like? Where does sales get involved? What are those different motions? So that we can capture and calculate and, that data correctly. And then finally, what metrics must adapt? Again, this is my framework, but just circled some things here, right? How we track bookings, really important. You know, if we have usage and subscription revenue retention, we're going to calculate usage retention, subscription retention. Maybe we have managed services. We'll calculate retention on that. And then go to market efficiency, LTV to CAC payback, cost of ARR. So we have to think about, all right, how are we feeding all this data into this metrics framework? So again, Scott, we could talk hours on a lot of this stuff, but just a quick teaser on.
Yeah, no, this is great context, and Ben, I really appreciate you sharing it with everybody. So let's kind of move on to part two. Uh, the first thing I want to talk about is using metrics as an operational tool. And so let's say things aren't going to plan, right? And the forecast model is suggesting outcomes that are going to be meaningfully below what your goals are. How would the CFO and the revenue leaders use your forecast model or any of the other metrics for that matter, kind of in an operational mode to kind of to help them decide what actions are we going to take to actually improve
Mhm.
outcomes? Do you end up getting into that level of kind of metrics informing strategies and actions with your clients?
Yeah, definitely, because that's where people say, metrics are just backwards looking, they're historical. But the thing is, we're calculating historical metrics and forecasted metrics. So if you look at this framework before I close it, uh, is I'm forecasting go to market efficiency. I'm calculating our financial profile. Calculating org efficiency. So that's where I see, all right, here's where we're performing. Maybe it's not up to where we want to be. And then as we invest and go to market, well, where is it going? Is it getting inefficient, efficient? And that's where I can work with the founding team, the CRO, to say, well, if we're going this way, it just doesn't work, right? We're just too inefficient. It's going to use a bunch of cash. So that's where we can be more predictive and forecast the outcome of our efficiency and have those conversations with the CRO or founder.
So if I paraphrase, I would say metrics, the models. are useful to stimulate discussions that need to be had because they'll identify upcoming risk areas.
Yeah. Yes, definitely. Because let's just say we look at our CAC trends and they've been going up. I have one client where it's like, yeah, CAC trends have been going up. All right, let's work with marketing. Why is that? What can we do? Let's forecast CAC and CAC payback and be more proactive. So the whole point with all this going through all this data is to make better decisions and to be proactive, to go from backwards looking now to thinking about, all right, forecast resources, cash runway, efficiency, and using this framework and this data to help, the leaders at the table.
What I like about this discussion is sort of the connection between CFO and go to market, and specifically, for example, so at Scale Matters, I mean, we get kind of deep into the next layer of metrics, right?
Mhm.
So very deep in terms of funnel analytics on new acquisition, et cetera. And what we'll do is we'll organize this data to try to answer key questions that these revenue leaders should have. So, for example, if your efficiency is getting down, maybe your conversion rates through the funnel are starting to suffer. So, you need to be able to look at data in a way that helps you understand kind of where is the leakage, right? Where is the friction? And then more importantly, what's the root cause of it? So this is a classic insight panel that our customers would have where it basically identifies top to bottom of funnel where the primary leakage point is, and then does this analysis. Think of it as dimensional slicing. We look at that point and say, all right, is there some relationship? We're kind of looking for an R squared, right? Is there some relationship to channel? Is there some relationship to sales team? Is there some relationship to the segment that we go through? So I'm showing this to have people understand that metrics and data in general is a layering approach. And from the top, which is sort of what you've been showing, it helps people put themselves in the right part of the ballpark, right? And but then you need to have the level of infrastructure and data posture to peel back the onion and get into very detailed causality understanding because that's what's going to inform actions that you take. Does that make sense from your perspective?
Oh, yeah, definitely. I mean, you're showing a lot of data kind of upstream from my process and super important where CFOs don't influence the process maybe, but we have to understand like what you're showing here, the lead funnels, conversion points, etc. Yeah, so all stuff we have to understand because that'll make us better at our job in FP&A and as a CFO.
So related to that, and I want to go to your 80/20 uh, uh, concept in terms of modeling. Again, one of the things that we do with our customers is we work with them to build these tediously
Mhm.
uh, um, specific new logo bookings models, right? Because it's what helps them start to build their plans and their strategies because then they can do all kind of scenario modeling off of based on historical actuals, et cetera. In a kind of conversation prior to starting this webinar, you said to me, it needs to be done, but we don't want that to be finance's responsibility. Talk to me a little bit about that.
Yeah, because say you look at the spreadsheet, and that's where I follow the 80/20 rule, where I'm really relying on the CRO, VP of sales, to be doing this homework that you see in the spreadsheet. The lead flow, the pipeline flow, what does that, then result in those estimated, closed pipeline, the weighted average pipeline that we're going to close. And then I'm going to take those new assumptions because really at a basic level, to do my new revenue forecast, I just need how many new customers that we're landing, what's the ACV of those customers. So some pretty basic data. And you see some forecast models that want to go from that, top of funnel, and progress through it, and it just gets too tedious. It's hard to maintain, and I'm not a big fan of that. Now, If no one's doing it, well, maybe, the CFO or fractional CFO has to do it. But really, I want the GTM team to be making those assumptions and then feeding me the data that I need to then forecast the new revenue layer.
I accept that. I mean, I'm probably more in the camp of encouraging the finance org to take more responsibility for it, just because it's still within their comfort zone of where they're skilled. But let's not debate that. What I'm interested in is understanding how often do you see companies that even go to that level of detail?
Yeah, I'd say under 10 million in revenue, pretty rare. Usually I'm looking at trends and determining what would be a good revenue forecast based on history and retention layers. But also, getting to that point where saying, hey guys, what does the pipe look like for next quarter? The quarter after that, because rather than trending a forecast, revenue forecast, let's get it a little bit more precise here. So it's then, changing, and so, but above 10 million, I'd say, yeah, like, yeah, there's got to be a little bit more sophistication from the sales side. And that's where I've gone in and audited, like, look through the data. Does it make sense? But again, I need that leader to own their forecast and not me telling them what they should forecast on the new and expansion side.
Yeah, I'd say so. We typically deal with companies that are 10 to 150, 200 million in size at Scale Matters,
Mhm,
and we rarely see what we would consider detailed enough bookings models
mhm,
below 50 million.
mhm.
In fact, really, if there isn't an analyst, a dedicated analyst at the company, what we generally see is, here are our goals. That means we need 3x pipeline coverage.
Mhm.
Marketing's responsible for 60%. Now, sales for 30 and partners for 10, and they call that a plan. And the
Yeah.
problem is it's just not a plan. That's a distribution of goals,
Mhm.
and it doesn't help revenue leaders understand steps they could actually take to make sure that they're achieving those goals. So, interesting. We have a couple
Mhm.
more questions I want to make sure we touch on. Uh, should Daniel Borges, should the metrics, generally speaking, be calculated from bookings or gap revenue? You want to talk to that?
Yeah, Daniel, good question. It's a mix, because say my pillar 5 and go-to-market efficiency, that's derived from bookings data. If that's our go-to-market motion, close one deal, CRM data, all that stuff, and that will be bookings data versus any RevRec stuff or P&L data. So my 4 key SaaS finance data sources: bookings data, HR data, financial data, and then customer/revenue data, or you can think kind of invoice data. So we need both, and some are based on P&L information. Think about the retention waterfall. That could be your RevRec schedule, creating your MRR waterfall. But go-to-market efficiency, really, it's accurate tracking of bookings data.
Yeah, I think a simple way to think about it. Well, I guess, Ben, you could also talk. Well, this would still be CRM, but your friend Ray Reich likes to
Mhm,
break CAC down into blended CAC, new logo CAC, and existing business CAC. Uh, Generally speaking, you can think of the bow tie, right? If it's new logo related, left hand side of the bow tie, it's largely going to be data in the CRM.
mhm.
If it's existing business retention metrics, it's largely going to be data out of the ERP billing system, that sort of thing.
Yeah, because usually with the founders that I work with, when I grab their CRM data, I need that new layer, and then I need the net expansion,
Right.
because, right, that then dictates what you said, like, and there's a question on cost of ARR, which is the cost to acquire $1 of net new ARR, which we can do on a blended, a new, and expansion. And that's always that big thing in the CRM data is, all right, what's a new deal? What's an expansion deal? What's net expansion? Or, if you're PLG self-service, we don't speak bookings data. We are going to derive that from our MRR waterfall and our revenue data and derive a kind of a implied ARR bookings number.
Cool. Thank you, everybody, for your time. Ben, thank you again. Really do appreciate it. It was good stuff, and I'm sure very helpful to people.
Yeah, no, appreciate it. Thanks for coming on. Always love sharing some content on my side. So, guys, thanks for joining. I know everyone's busy. If any questions, just email me. Happy to point you in the right direction.
Make no mistake, good data matters for driving efficient growth and valuations. Follow me on LinkedIn, where I'm sharing insights from CFOs, investors, and strategic go-to-market execs. Thanks for listening to The Data Room.